The paper F3 exam is based around not just multiple choice but objective tests, as they're called. In other words, small short form questions worth 1 mark or 2 mark each, and asking you generally to calculate a particular figure or explain a particular concept and choose from a drop down menu perhaps. Now that lends itself very much, that format of the exam, very much lends itself to testing what we're looking at now, a thing called the business equation. A business equation, otherwise it's a slight variation of a thing we've looked at already called the accounting equation. The business equation just takes a look at what the increase or decrease in the net assets of a business has been in a period and looking at where it came from. Now the way this comes up in the exam is that you'd be given some of the figures and asked to find the balancing item. So you might be given the assets at the end of the period or the end of the period, a number of the figures, and you have to work out, for example, what the capital introduced in the period was. Okay, now it's actually quite a simple thing if you think about what net assets of a business are and what might cause those net assets to increase or decrease. An increase in the net assets of a business could come from a number of places. Okay, it could come from total comprehensive income, in other words, profit, as it's likely to be, I think, in the paper F3 exam, but it could include other gains as well, like a revaluation of property, plant and equipment, tangible non-current assets, in other words. If you've revalued those in the period, that's a gain because it's increased net assets, and an increase in net assets is the definition of a gain or income. But it's not considered to be a very certain gain, so it gets taken through other comprehensive income. So we'll say profit here. There might be other things as well. There might be kind of other gains taken directly to equity. Okay, new capital introduced by the owner, that's going to always increase net assets. And the opposite of that is withdrawals, otherwise known as dividends, or it could be drawings, some people call that. Or it could be dividends, or it could be, dividends or drawings will do it, whether it's a private limited company, a public limited company. Any limited company is called dividends. Any sole trader or a partner is called drawings or withdrawals. Okay, withdrawals in the period will always reduce the net asset of the business. It's sometimes called a business equation, not really quite sure why, because to be honest, it's a statement of the relatively obvious. It's just a reconciliation of the net assets at the start of the period to the net assets at the end of the period. It's extremely likely to be at least one of the multiple choice items that you'd get in any paper F3 exam. Okay, well, the way to look at this is the closing net assets of the business, logically, is the opening net assets plus the total comprehensive income in the period. Probably just going to be profit for the period. Now, profit, remember, is the net of all income and expenditure. And income and expenditure, just by definition in IFRS accounting, is an explanation of where net assets came from or went to. An increase or a decrease in net assets is always income. Okay, any new capital introduced by the owner, and the opposite of that is any withdrawals. So in other words, that kind of explains where any increase or decrease in the company's net assets in the period might have come from or gone to. Remember that net assets by definition is the same as equity. Okay, plus liabilities. Equity as well, by definition, in a private limited company or a public limited company, any company, is capital plus reserves. And in the case of a partnership, that's what equity is. In the case of a partnership, it's the partner's capital and the partner's current accounts. If you've not looked at these items yet, don't worry too much. Basically, all we're looking at this stage is the fact that net assets can increase during the period by a number of different possible reasons, and it will decrease by money taken out of the business by the owner or the owners of that business. So let's make up a quick example of this. This is a thing called, we actually have to produce this in a full set of financial statements if we're reporting under IFRS, which is a statement of changes in equity in the period. Now, equity just equals net assets. So equity at the start of the period, I'm just going to call it net assets, at the start of the accounting period. Let's say we have an accounting period that starts on the 1st of April 20x2, and let's say that that business had net assets of 100,000. The things that might increase it would be profit, plus any other comprehensive income, which is probably a little bit unlikely in the paper F3 exam, but it could be there. What's going to reduce it are withdrawals, otherwise known as dividends, otherwise known as drawings. I think in the exam it's likely just to be called withdrawals from the business. And the other thing that would increase it is going to be new capital introduced. Now, just making up some examples here. Suppose that you have a question that says at the start of the period the net assets were 100,000 and you're told that other comprehensive income was 5,000. Well, comprehensive income would increase net assets. You're told that the owner of the business withdrew cash or other assets to a valuation of 25,000. Well, if they kind of cross that line between their personal activities and their business activities, that's either capital introduced or is withdrawals taken out. And let's say they introduce new capital of 60,000, and the question then would say, what was the profit for the year? You can expect this kind of question is going to very much work along the principles that you'll be given all of the figures that you need minus 1. Okay, well, if I add this figure up, 100,000 plus 5,000 minus 25,000 plus 60,000, by my calculation, is 175. No, it's not. Let's try that again. That doesn't seem right. By my calculation, doing it again, this time being a little more careful with my calculator, is going to be 140. That seems more sensible. So if I add up the figures I know, that tells me there must be a balancing item there, and that must be a plus of 10,000. So in other words, if this were, the answer would be that we've made a profit in the period of 10,000. The thing to do is very much start off with the pro forma and then just see which figures are missing. It could be quite easily, just to make up the same example here, they might say the profit or total comprehensive income was 15,000. Okay, so profit of 10 plus other comprehensive income of 5, capital introduced of 60, net assets of 10, and net assets at the end of the period, I should have written this in here, net assets at 31 March 20x3. And the question then saying, well, how much did the owners take out of the business in the period? Well, the thing that would make that balance would be a negative figure of 25,000. By convention, by the way, accountants tend to write negative figures rather than using a minus sign on a number. They tend to put brackets around them, the simple reason being that it makes it rather more legible and easier for other people to follow. Now, the way to approach this in the exam is, first of all, understand what net assets are. Net assets is equity, it's assets less liabilities. Okay, just like if you have positive equity in an apartment you own, it means the asset is worth more than the loan to pay for it. Just think what might increase and decrease net assets in a period. Okay, well, net assets are going to increase by profit and other comprehensive income. They're going to go up as well if the owner's put some more money in, and they'll go down if the owner's taken some money out. I would just recognise this pro forma. Don't think about it too much while you're writing out the pro forma, the sort of template. Drop in all the figures that you're given in the question and just see which one is the balancing item. Hey presto, that is going to be your answer.